question really is, do you want to have credit attached to Bitcoin or gold? You want stability. You don't want something that's going up and up and up and up. Do you see what I mean? Gold is stable.
Yes.
While the price is rising, actually, that's not what's happening. It's the purchasing power of currencies going down. And this is the key thing, which I don't think anybody really grasps. China really does control the physical gold market. And I think she's seeking to control the paper market as well, or take the control, if you like, away from the West. And there are very good reasons for doing this. And it's a policy which has just accelerated recently because her response to American trade sanctions has been very much.
While no official gold-backed currency has been unveiled, discussions have included using gold reserves to back trade settlement. Leaders of the BRICS nations expressed interest in developing a new trading currency backed by gold or other commodities. A celebrated stockbroker, Alasdair Macleod, suggests that linking credit to gold ensures stability, unlike Bitcoin. In this video, Macleod predicts that as the dollar weakens, BRICS and the global south will seek a new sense of direction. He mentions that China may offer a gold-linked external yuan. As global power dynamics shift, China is steadily advancing a long-term financial strategy aimed at reshaping the international monetary order. Central to this effort is a decisive move away from the US dollar, a currency that has dominated global trade, reserves, and finance for nearly a century. In its place, China is betting on a dual foundation, gold and the yuan. Based on market trends, Macleod explains that stabilizing the dollar is nearly impossible due to America's worsening debt trap and a credit bubble worse than that of 1929. According to him, the Fed faces intense pressure to cut rates, but doing so would further erode the dollar's value. The dollar slid on Thursday due to heightened expectations of Federal Reserve rate cuts this year and lingering uncertainty over the tariff battles. The greenback has plummeted to three-year lows, down nearly 10% against major currencies in 2025, marking what BOTE Finance Institute analysts identify as a seismic shift in global capital flows. This isn't just another FX correction, it's the beginning of a new investment paradigm that savvy traders are already capitalizing on. In a surprising market twist, Macleod highlights how bond yields surged, the dollar weakened, and gold prices climbed all at once. This rare combination signals that global investors are abandoning the dollar and seeking safety in gold, which they view as a true, legal form of money. Before we dive into Alasdair Macleod's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I think one way to sum it up is that China really does control the physical gold market. And I think she's seeking to control the paper market as well, or take the control, if you like, away from the West. And there are very good reasons for doing this. And it's a policy which has just accelerated recently because her response to American trade sanctions has been very much to take the view, right, well, as I said, we've got to protect ourselves. It's really what they're saying. And so they've accelerated, trade relations and all the rest of it, diplomatic relations around the ASEAN nations, of which I think Singapore is one. They've said, and this is really, I think, preparation for the protection of the yuan. They've said, we will open gold vaults outside China. This is a completely new departure. And so far as I understand it, they've said they're opening one in Hong Kong and they're opening one in Saudi Arabia. Why Saudi Arabia? Because that's their biggest oil supply. So, and I actually think it's demanded by the Saudis as well. So you can see that this is sort of going into place. Now, when it comes to the paper markets, they've also opened up the Shanghai Futures Exchange to foreign institutions. And that was announced, a couple of weeks ago. And it's not just gold and silver, it's also all metals. So that, a foreign bank, like, say, JP Morgan or whatever, doesn't have to set up a Chinese entity in order to deal on the futures exchange. It can deal direct, just as a Chinese bank can deal direct through Globex on COMEX. These are very, very important steps. it gets very little commentary, if you like, in the public arena. But I believe these are extremely important steps, and it shows a desire by the Chinese to get control over the gold market. And why do they want to do that? They want to do that to protect their own currency, because China knows that real money, as opposed to credit, is gold. And if you're going to have a fiat currency problem, then you have got to be able to protect the purchasing power of your currency by linking it to gold. Now, I think, initially anyway, really what China's looking at is looking at it from the point of view of a firm yuan for trade purposes, because obviously you've got, you've got a domestic yuan, you've got an external yuan, as it were, you've got exchange controls. So this is really something which is aimed, if you like, at protecting her position in her overseas markets being the Shanghai Cooperation Organization and also BRICS. And the reason for doing this is really, I think quite simple. She can also see that as the dollar goes down, there's got to be a currency which replaces it for BRICS trading. And the idea that you can accept other currencies, come on, they'll go down with the dollar. And in any event, a lot of these currencies are pretty, you wouldn't want them anyway. Would you really want Turkish lira, for example? I think the answer is no. Would you want, Iranian rial? I think the answer is no. So you can see that, there is a need for a currency common, if you like, to what's called the global South and Asia. And China is looking to provide it. At the moment, just providing it for non-domestic transactions to, if you like, guarantee her trade position. But I think if she does that with her external interests, then I think it will also help provide stability to the domestic currency. If it doesn't, then they'd have to sort of think about, extending gold protection to that currency. But it's all going to depend on what happens to the dollar. Let me put it this way. It's from the point of view of stabilizing the dollar, it's the worst possible thing they can do because of this debt trap situation. However, I think we're going to get into a situation where, as the credit bubble, and if you don't believe we've got a credit bubble, just look at there's a debt bubble at the moment. Now, the debt equals credit. It's the other side of it. So if you've got a debt bubble, you've got a credit bubble. If you've got a credit bubble, you've also got Smoot-Hawley Mark II, Tariff Act. These are precisely the situations that America had in 1929. This time it's worse. So the way things are going to evolve is that the dollar is going to get undermined. Financial markets are going to get undermined. And the only way, in theory anyway, to stop this or slow it down is to raise interest rates, which will kill the equity market even more, but might offer a little bit of protection to the dollar. Because if you've got higher rates, then, okay, you might sell equities, but you'll probably leave the money on deposit at a bank in dollars, sort of thing. So particularly as under those circumstances, other currencies will look even less attractive than the dollar. Look at the European situation, for example, or the Japanese situation. So, one way or the other, the Fed is going to have a really difficult choice on this one. But I think eventually, as businesses and pretty fundamental businesses start going bust, which I'm just saying what happened in 1929 to 32, whether it's businesses or banks, lenders to businesses. In those days, it was the farming industry mainly, if you like. But this, today it could be anything. It could be high-tech businesses. I think that you'll find that the Fed will have to rescue quite a lot of what's going bust. Now, when it's doing that, how does it do it? One way in which it has to respond is to take the pressure off the economy by lowering interest rates. But it can't do that because it'll just kill the dollar and make the situation even worse. So, the Fed is getting into an extremely uncomfortable position. And I think this is basically, if you're a central banker, you can see this. You can see this happening. You can see the problems and also the political pressures on the Fed to reduce interest rates. The market pressures, everybody in the market, with very few exceptions, of which I'm one, believe that interest rates will go down. central bankers see this differently. They see this as being really an extremely dangerous and difficult situation. And would they really rather want to hold all the dollars they've got? I think they would rather lighten up, and that's what they've been doing. And they've been doing it now for the last 4 years. Well, it's fascinating because recently something happened which the macroeconomists believed was absolutely impossible. And that is you had a rise in the bond yields, a fall in the purchase in the dollars trade weighted, and a rise in gold. Now, I mean, this is impossible, we were told. Absolutely impossible. But it happened. And the answer basically is that it reflects foreigners getting out of dollars. And they get out of dollars by buying gold, because gold is real money, real legal money to everyone around the world.
Regarding the gold market, Alasdair Macleod explains that bullion banks rushed to move gold to COMEX during Trump's tariff threats, resulting in over 2,100 tons of deliveries across 4 years. Much of it was likely leased and permanently withdrawn, mainly by Asian buyers and central banks. Now, as central banks reduce leasing, paper market liquidity is tightening, which supports gold prices despite low hedge fund interest. Gold lease rates held negative again, costing would-be lenders 0.15% annualized, even after accounting for the bank interest they would make on the cash value of their bullion loan, and suggesting a plentiful supply of the safe haven metal. A notable trend accelerating under Basel III is the repatriation of gold by central banks, bringing physical holdings back from foreign storage to domestic vaults. According to IMF data 2024, 15 central banks repatriated 543 tons of gold in 2023, representing a 60% increase from 2022 levels. Let's get back to the interview.
For example, quite a lot of people within the bullion bank system see gold coming back into the UK vaults. Now, I don't think that's quite right, because really the problem I think that the bullion banks had was that when Trump threatened 25% tariffs across the board, when he first got elected, they sort of thought, well, if gold is going to cost 25% more in America, we have got deliveries which we have got to make. We don't have the gold necessarily to cover it. And not only that, but we're going to have future deliveries. So you can see why there was this panic, if you like, to move over. And the one thing that nobody seems to watch are the stands for delivery. I mean, they are absolutely huge. The rate at which they're running this year so far is roughly 1,500 tons for the whole year, if you extrapolate what's happened so far into the whole year. I mean, that's a lot of gold. And something like 850 tons, or something like that, was what moved over, if you like, into COMEX from London, Switzerland, and also places like Mumbai, believe it or not. I mean, so the arbitrage opportunity was so great. The problem is that we don't know who is actually standing for delivery. And gradually, as the stands for delivery occur, a lot of those people who stand for delivery withdraw it from the COMEX warehouse system. And that is now what we're beginning to see, because the level of stocks within COMEX warehouses is now beginning to decline. It's still very high, but it's beginning to decline. And this was something that happened after the spike. If you remember, at the time of COVID, later on that year, there was a similar situation where you had a spike, if you like, in gold going into COMEX. You had the premiums again on futures, which were driving it. And you ended up with far higher levels of gold bullion in the COMEX warehouse system. Gradually, after that happened, the level of gold in the warehouses actually diminished, and it went down and down and down until this recent spike up. And I calculated that in about the last 4 calendar years, something like 2,100 tons of gold had been stood for delivery. Now, of course, some of that may be between bullion banks. I mean, we really don't know the answer to this. But the other thing that we are seeing is that the managed money category on COMEX is having less of an influence on things. I mean, you've got a pretty low level of outstanding open interest. I mean, it's around about 417,000, which is pretty low, particularly when you see gold going up to new highs. I think the other thing about this was that the rapid pace of gold going out of the Bank of England's vaults. Now, I mean, some of that, sort of, if you like, owned without future obligations, if I can put it that way, lease obligations, as it were, by commercial entities. But I'm sure that some of the gold that went out was probably leased gold. In other words, you see, when you lease gold, it becomes your property. I mean, if you're the lessor, it becomes your property until, under the terms of the lease, you return it. I mean, it's exactly the same like you go down to the local, sort of hardware place and you lease, say, a lawnmower to do your lawn. That is your property until you return it. Obviously, you've got to return it as you picked it up. Yeah, but it's your property legally at that point. And it's exactly the same with gold. A lot of this gold, I think, went out. And of course, where's it gone? Can it actually come back? I mean, the answer, I think, is that most of it probably doesn't. Most of it's probably gone into interest, if you like, in Asia. Central banks will have bought it and stood for delivery, I'm sure, and so on and so forth. But you've got to consider, where does that leave central banks who have been quite happy to lease their gold in the knowledge that the Bank of England was actually running things, sensibly, and leased gold wouldn't leave the storage of the Bank of England, because the way it works for the Bank of England is that they make a change in the register as to who owns what and all the rest of it, and they can issue a certificate to a commercial bank saying, yes, we store 100 tons of gold, or whatever the figure might be, of your gold, because it's been leased to you. It doesn't necessarily say it's it's leased, but at that stage it is a commercial entity's property. From the point of view of central banks using this leasing thing to make gold work for them, get a little bit of interest to pay back the storage costs and all the rest of it, you begin to think, hold on a minute, is this a good idea? And I think on the margin, what's happening is that banks are withdrawing from leasing now, which will be creating a gradual tightening of liquidity within the paper markets. Not just London, but also knock-on effects elsewhere, because the way London works is that London very often is long and it shorts, it has the short side on COMEX. That's the idea anyway. Now, whether it actually works like that, it is an open question, because nobody tells us what their positions are. You can see that if central banks don't play the leasing game anymore, then they're going to take the liquidity away from the markets upon which paper markets depend. So I think that's roughly where we are. And I think this is one reason why gold seems to be holding on to highs, despite the fact that the managed, if you like, the managed money, which are basically hedge funds, they just haven't bought it. There's some in there who have it, obviously. But the idea that they're really long, this is overbought, it's not overbought at all. It's quite extraordinary to have an oversold market, which is close to all-time highs. I think it's a reflection, if you like, of the systemic squeeze in the case of COMEX, particularly on the swaps.
Central banks worldwide, and specifically those of the BRICS, have been increasing their gold reserves to reaffirm gold's strategic importance. In a 2024 Gallup survey, over 25% of Americans identified gold as the best long-term investment, ranking it second only to real estate. That tally has risen consistently in the wake of the pandemic, and amid rising worry over inflation and global de-dollarization. Are we ready for a world where economic power is anchored not in trust in governments, but in trust in real money? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.